Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hbm Holdings Limited annual report. Hbm Holdings Limited is a biopharmaceutical company that provides various businesses and services related to the discovery, development, and commercialization of antibody therapeutics. The company focuses on immunology and oncology treatments in multiple regions worldwide. The company offers several key services, including the development of novel antibodies through its Hbm platform, which generates human monoclonal antibodies in different formats. Hbm Holdings is also involved in the development of various therapeutic candidates, such as batoclimab, Hbm 9161, for myasthenia gravis and porostabart, Hbm 4003 for melanoma and other cancers. In addition to its research and development activities, the company provides strategic collaboration services through its partnership with Evanova. This collaboration aims to enhance the efficiency of biologics development using AI and digital technologies. Furthermore, Hbm Holdings is involved in the treatment of various diseases, including hematologic carcinoma, autoimmune diseases, asthma, chronic obstructive pulmonary disease, and solid tumors. The company's pipeline includes multiple therapeutic candidates, such as Hbm 7020, Hbm 9378, Hbm 1020, Hbm 1022, Hbm 9014, Hbm 7022, Hbm 7008, Hbm 9027, Hbm 7004, and Hbm 9033. Overall, Hbm Holdings Limited provides a range of businesses and services related to biopharmaceutical research and development, including the discovery and commercialization of antibody therapeutics, strategic collaborations, and treatment of various diseases. Hbm Holdings Limited market capitalization of $12 billion is materially smaller than most of its industry peers of roughly $44 billion. Hbm Holdings Limited trades at a lower price-to-earnings ratio of 19 times and a higher price-to-book ratio of 3.71 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 42% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. At the same time, profits have grown exceptionally fast while the share count has declined. This suggests management is generating substantial earnings while actively concentrating value into fewer shares, an extremely positive signal for long-term investors. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The financial health of a company can be measured by its ability to generate positive operating cash flow. In this case, the company has successfully achieved this milestone. According to the provided data, the company's operating cash flow stands at $316,849. This is a significant indicator that the company is financially stable and able to cover its operational expenses without relying on external funding. The generation of positive operating cash flow also suggests that the company's revenue streams are sufficient to support its business activities. Overall, this achievement demonstrates the company's ability to manage its finances effectively and maintain a healthy financial position. The company's debt level has experienced a significant increase over the past year. According to financial records, the total debt rose from $90,962 in 2024 to $133,144 in 2025. Furthermore, bank loans increased by 23% from $59.4 million to $73.5 million, while interest-bearing bank borrowings skyrocketed by 351%, jumping from $3,000 $862 to $17,480. In contrast to the rising debt level, the company's interest expenses have actually decreased. Specifically, interest expenses dropped from $3,505 in 2024 to $2,041 in 2025, representing a notable decrease of 41%. This reduction in interest expenses suggests that despite the increased debt, the company has managed to secure more favorable loan terms or negotiate lower interest rates with its lenders. Management is emphasizing the company's strategic direction through several key initiatives. The primary focus is on building a robust portfolio and differentiated pipeline, driven by internal R&D capabilities, strategic collaborations, and selective acquisitions. This approach aims to establish the company as a leader in next-generation biotherapeutics innovation. To achieve this goal, management is prioritizing the advancement of two core pillars: Hbm Therapeutics and Non-A Biosciences. The company is also investing in ventures focusing on next-generation innovation, co-developing novel NK cell therapy with NK Cell Tech, and diversifying deployment of next-generation innovation. Furthermore, management is exploring new channels for platform technology, value creation, and conversion, as well as creating new opportunities through partnerships and collaborations. These efforts are expected to drive sustainable business growth and position the company as a global leading platform-based biopharmaceutical group by 2028. The company's outlook is optimistic, with several key developments underway. The BLA for batoclimab, Hbm 9161, is currently under review by NMPA, indicating a positive regulatory outlook. Additionally, recent clinical trial results are expected to further optimize the market potential of Hbm 9161. Overall, management's strategy aims to establish a strong foundation for long-term growth and success. The financial performance of a company can be gauged through various metrics, including its dividend payout and share buyback activities. In the case of this particular company, it has been observed that there was no payment of dividends in 2024 and 2025. However, the company did engage in share buybacks during this period. This is evident from the effective dilution weighted average number of ordinary shares, share granted under share awards scheme, line on page 46. The fact that the company bought back its own shares indicates a strategic decision to reduce the total number of outstanding shares, which can have a positive impact on earnings per share. In conclusion, while the company did not pay any dividends in 2024 and 2025, it did undertake share buybacks as part of its financial strategy. There are growing concerns among businesses and economists regarding the potential for inventory buildup. This issue arises when companies produce more goods than they can sell, leading to a surplus of unsold products. The consequences of inventory buildup can be severe, including wasted resources, reduced profit margins, and decreased competitiveness in the market. The root causes of inventory buildup are often linked to supply chain disruptions, which can occur due to various factors such as natural disasters, transportation bottlenecks, or changes in consumer demand. When a company's supply chain is disrupted, it may struggle to meet customer demands, leading to an accumulation of unsold products. In addition to the economic implications, inventory buildup also has environmental consequences. Excess inventory can result in waste and pollution, as companies are forced to dispose of unwanted goods. Furthermore, the production process itself contributes to greenhouse gas emissions, exacerbating climate change concerns. To mitigate these risks, businesses must adopt more agile and responsive supply chain management strategies. This includes implementing just-in-time production methods, diversifying suppliers, and investing in data analytics to better predict consumer demand. By taking proactive steps to manage inventory levels and minimize waste, companies can reduce the likelihood of inventory buildup and its associated consequences. That concludes the financial summary for Hbm Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.